Good morning, good afternoon. My name is Patrick Theriault. I am a Managing Director with Strategic Risk Solutions. I've been involved in captive management for about 25 years now. And for those of you that do not know SRS, we are the largest independent captive manager in the world. All right, without further ado, let me share my screen here and let's get started. Great. Okay, I'm excited to spend the next 10 minutes or so with you reviewing a high level all captive insurance coverage may or may not differ from commercial insurance. Here, a quick table of content with some of the topics we'll cover. And let's get right into the content. Okay, before jumping fully into the coverage topic, I think it's important to present or represent a few basic components of captive insurance, as it is helpful in understanding some of the coverage flexibility captives provide, and maybe more importantly, the limitations they may face. First, while if captive is a formalized form of self-insurance, a captive insurance company is, in fact, a licensed insurance entity, and therefore it provides many of the same benefits available to commercial insurance companies to the captive owners. That said, however, a captive is typically only licensed in its country or state of domicile, and therefore unauthorized in all other countries or states. This is important as it limits the operations of the captive and its coverage ability. More to come on that. So it is beyond the scope of today's conversation, but you should keep in mind that the specifics of the captive program may expand or limit its coverage ability, whether it's the domicile or the captive form. So keep that in mind. Okay, there are a few clear coverage limitations that I felt was important to know from the start. There may be solutions to mitigate or sidestep some of these, but generally captives are first generally limited to first-party coverage, meaning covering the risk of the captive parent owner. Again, there's some limitations around, some exceptions around this, but most typically first-party coverage. Second, most U.S. captive domiciles prohibit captives from offering personal lines coverage. Homeowners and personal auto insurance are good examples. Third, captives will most often not meet statutory coverage or financial responsibility requirements, probably one of the biggest barriers to captives. Workers' compensation and commercial auto are two common examples of these limitations as it relates to statutory requirements. Now, that does not mean that a captive could not assume workers' comp or auto liability risk, but the captive can only do so in tandem with commercial coverage participation, such as the captive operating as a reinsurer. Finally, of note, captive insurers do not provide access to state guarantee funds. State guarantee funds were created to protect insureds in the event of insurer insolvency. So again, this is not access to the captives and something that might be relevant. Here on this slide, we present a long list of common captive coverages, with the coverage in the gold color representing the most common captive coverages by category. The beauty of captives is certainly their flexibility. And as you can see from the number of coverages listed, outside of a few limitations that we previously noted, and subject to regulatory approval always, captive insurers could more or less assume any risks of the captive owner that can be quantified. For this reason, it's not unusual for the captive insurers to be at the forefront of new risk exposures, and we'll touch on that a little bit later on. A common question that we get when completing a captive feasibility study for a potential prospective captive owner is whether or not they could use the captive to fully replace commercial insurance. Generally, outside of certain exceptions with very large organizations, unfortunately, the answer to this question is no. This is in large part due to capital limitations and some of the market or regulatory restrictions that we previously noted. However, that said, captives will sometimes act as market of last resort when commercial options disappear. An example of this would be a coverage for asbestos and mold exposures that are now generally unavailable commercially or fully excluded, but could possibly be financed via a captive insurer subject to regulatory approval. A more recent example would be sexual abuse or molestation coverage, whereas many organizations are being forced to turn to captives for coverage availability because the commercial market is refusing to cover that risk at this point. Also, due to their flexibility, as previously noted, captives are sometimes at the forefront of new coverage options. A recent example would be cyber coverage. So before the current market options currently available for cyber, not that long ago, captives began writing coverage before much of the commercial market existed. So captives have also been at the forefront of other coverages such as business interruptions more recently. Okay, let's now spend a few minutes putting captives and the commercial market side by side to highlight some of the key differences. First, as it relates to coverage type, while primary direct coverage can be obtained commercially, captive coverage will generally be on a reinsurance basis. So big difference of direct versus some other form of coverage access. So what I mean by this is that coverage requirements will generally be met by a level of commercial insurance participation. Very rarely does the captive would write direct by itself. And under those scenarios, the captive provides some form of risk funding in combination with the commercial market. So there are exceptions, but frequently the case. As it relates to coverage form will generally be market-driven and restricted from a commercial market perspective, but flexible with captive insurers. So, for example, several industries that had historically purchased occurrence coverage form policies are now limited to only claims-made form commercially. And the only way perhaps for them to access occurrence form, if that's their preference, would be to turn to captives. Medical malpractice is a good example of that, where in most cases, claims-made is the only option available commercially. As it relates to coverage terms, terms are frequently pretty defined from a commercial perspective, with most commercial policies having similar forms, following standard forms such as ISO forms. While with captive insurers, there's minimal limitations, and with captives often using many scripted policy forms to best meet the needs of their insureds. So due to the standard form or standard nature of commercial coverage I just mentioned, usually commercial coverage is pretty widely accepted by third parties. On the other hand, while captive coverage policies may be reviewed more closely by third parties due to the manuscript nature, or just because the fact that the captive does not have a third-party rating, meaning most typically AM Best rating. In worst case scenarios, captive coverage may not be accepted at all, and the only option again might be to partner with a commercial market. One of the greatest benefits of captive insurance, when direct captive coverage, especially when direct captive coverage is available and possible, is the increased control that it provides. Control over claims management process sometimes, but most typically control over pricing terms, with pricing being with captives more responsive to their claims experience rather than market conditions, which are often driving commercial rates. The claims topic will be covering more details by the next speaker, so stay tuned for that one. Okay, to reinforce a few items previously noted, I want to expand a little bit more on captive coverage advantages. First, as a licensed insurer, again important, a captive can provide proof of coverage or certificate insurance to third parties, and that for risks that might be otherwise fully or mostly self-insured. So pure self-insurance typically would not meet third-party requirements, but self-insurance via a captive may allow to meet those requirements with the ability to provide, again, a proof of coverage or certificate of insurance by the captive. Second here, a captive may provide access to components that would not otherwise be available to entities without a captive. A few examples of this: one would be a captive owner could access the commercial reinsurance market, which they could not do so on a direct basis. So the reinsurance market is a wholesale market only available to insurers, and the captive being an insurer would provide access to that market which again, an entity could not access otherwise. It could also be possible with a captive to access some government programs that may only otherwise be available to insurers. The terrorism federal program would be an example of this. And finally, a captive insurer may provide access to revenue-generating insurance arrangements, such as participating in the insurance of a product extended warranty, for example, or other similar insurance components that that a captive may be able to provide access to that an entity could not do otherwise directly. Once again, though, of note, first and foremost, captives are all about control and control over, whether it's control over coverage form, control over pricing, control over coverage terms, or as previously stated on occasions, control over claims management. Control, control, control. Okay, and finally, now before I turn to the next speaker here, just a couple of quick takeaways. Reminder in summary: if you will only retain a couple items from the section, you should remember that captives are real licensed insurers and are regulated as such. So a lot of the benefits of commercial insurance come with a captive. As licensed insurers and regulated insurers, they can therefore provide broad coverage form. And while they can rarely replace the commercial market completely, unfortunately, as we noted, they are great vehicles to expand and complement commercial coverage. So with captive, at the end of the day, with captive insurance now representing more than half the insurance market, one thing is for sure is captives are not going anywhere. So captives are not going anywhere. They're here to stay, now representing more than half the overall insurance market. So if you have not come across captives yet, you will certainly in the near future. And again, thank you for your time. Look forward to the Q&A section.